Fantastic. So, Paul, apparently we're live. I'm not quite sure
excited.
where we're live, but apparently we are live. And really just want to kind of spend 20 minutes, hopefully no longer, but be open to answering any questions that we get for anyone who might want to dial in. Just sort of analysing a little bit about the budget that we've just heard, and in particular what it means to our clients who are predominantly small business owners or entrepreneurs or business owners who have sold their businesses previously and are maybe investing in other things. So I suppose to start us off, what would you say the biggest headlines were from that budget in terms of our client base?
So I think in some ways, some of the biggest news out of the budget was what wasn't in the budget. So not much in the way of changes to capital taxes. There were some specific changes around capital gains tax we'll talk about. Similarly, not a great deal of change around inheritance tax, which I think were the two areas that people really were kind of nervous that there might be changes. Not just our clients, but everybody. The freezing of the income tax thresholds for another 3 years to the end of the tax year 2031 is obviously a big item. It's a big news item, but I think we've all kind of got used to the fact that the thresholds just aren't increasing anyway. So that's that's something which is a big item, but probably not a major news. I think from a business client's point of view, the increase in the national minimum and the national living wage, again, that's going to be an impact on costs. So we're slightly torn in that situation because obviously you want people to earn a decent living, but equally the employers have to be able to afford to pay those people to keep them in jobs. So I think it'll be interesting to see how that plays out over time. But I think those sort of areas, the income tax changes, and also from a lot of business owners' perspective who are used to taking a lot of their reward through dividends, there's going to be an extra 2% tax on dividends from April 2026, which might again change that dynamic between do I take my remuneration through salary or do I take it through dividends. So I think there's a lot of thinking that's going to need to be done between now and the end of the tax year.
That's 3 months, 4 months to plan for, but Christmas comes in between, which always has people a bit less focused.
Absolutely, I think that's very fair.
So picking up on something that you said then before about sort of the freezing of the thresholds. So IHT thresholds have been frozen, income tax thresholds have been frozen, student loan repayment thresholds have been frozen. Can you explain to us kind of what that means and why that gets referred to as a stealth tax?
Yeah, so I think obviously the government made the commitment in their manifesto to say that they weren't going to increase the rate of tax. But essentially what these changes do is people's income naturally increases over time, all being well, whether it's through pay rises, just really the effect of inflation and the increase in sort of balances as interest accumulates in savings accounts. So there's lots of ways that people's income increases over time. If the tax thresholds between the bands stay the same, then inevitably that means more and more people are going to cross those thresholds and go from being a 20% taxpayer to being a 40% taxpayer, or even up to being a 45% taxpayer. The term stealth tax is a good term. The other term is fiscal drag, which is essentially basically saying that more and more people get dragged into the higher rate simply by the action of their income increasing, but the thresholds not changing.
Got you. Okay. So sticking with, I suppose, income tax to a certain point, in the manifesto, there were promises not to increase income tax, but there have been increases to dividend, savings and property income tax. Can you tell me a bit more about that?
Yeah, absolutely. And I think this is that the promise not to increase income tax seems to have morphed into the promise not to increase income tax for working people. And what these changes are really aimed at what we tend to refer to as passive income. It's income that you don't necessarily have to work in order to earn. Now, I'm sure there's people out there who've got rental properties who are banging on the desk and saying, I absolutely work. But in terms of what the tax law treats that, it treats it as kind of income that just accumulates by virtue of having the asset rather than by any input that you're putting in. And then what essentially those changes are. So as we mentioned, from April 2026, if you receive dividends, and that's not just SME owners who take a lot of their remuneration by dividends, but it's also anybody who's got a share portfolio who pays income tax on those dividends, they're going to pay 2% more on all the rate bands on dividend income, and then from April 2027, that extra 2% is going to extend to rental income and savings income. So I think this relates to a lot of the chat was going to be, well, the government's going to introduce national insurance on these types of income. So in a sense, they've been quite cute in terms of not introducing national insurance, but effectively adding on something which equates to the rate of national insurance, certainly for higher and additional rate taxpayers. But yeah, I mean, look, let's not beat about the bush. This is a tax increase, and so the manifesto commitment was we're not going to increase the rates of tax. Well, you know, they've broken that.
And I think for certainly for the small business owner out there who does tend to remunerate themselves from a lower salary and a higher dividend, there's a lot of planning that's going to need to be done between now and the end of March, really, this year.
There absolutely is. We had a real change last year in terms of the impact of national insurance rates and how that impacts on the conversation, and now we've got this change to dividend taxes. So it's almost we're in a constant state of flux to work out. And just because something was right this year doesn't necessarily mean it's going to be right next year. So there is going to need to be some thought required in order for people to make sure that they're optimising the tax position on what they take out of their company.
Okay, so I'm going to stay with the national insurance conversation then. Sure. And again, we were told there'd be no changes, no major changes to national insurance contributions, and no changes really to pensions. But what they've done is change the way pensions are going to be taxed from a salary sacrifice point of view. So what's salary sacrifice? Why is it beneficial? And what do we need to think about these changes that are coming? Sure.
So salary sacrifice at its most basic level is if I've got a salary of £50,000 a year, I say to my employer, well, actually, don't pay me £50,000 a year in salary, pay me £45,000 a year in salary, and pay me an extra £5,000 in pension contributions, because obviously I'm cracking on a bit now and I'm interested in saving for my retirement. So actually it's more, and because pension contributions can get paid in at the moment into somebody's pension fund without paying any income tax on that, and there's also no national insurance on that, it means that there's a potential there for the employer to make a saving, and the more generous employers actually share those savings with the individual, so as they actually tip more into their pension pots. Not only am I saving income tax, but I'm getting a kicker in terms of the extra pension contribution that's going in. Now, from as a result of these changes, and I'll have to, I think, was it 2029, wasn't it, that these changes were coming in? Yeah, so we have a bit of a breathing space, but what essentially the rules are now going to say from 2029 onwards is that effectively the maximum amount that you can use as a salary sacrifice amount and get those tax benefits is just £2,000. So I could still salary sacrifice £5,000, but essentially what that means is that beneficial tax treatment's only going to apply to the first 2,000 of that, and effectively it would then be in much the same way as I guess, without having seen the detail, as if I just made a personal pension contribution after my post-tax pay. So I'd still get taxed on the £3,000 extra in that scenario. There'd still be national insurance on that, and then actually make it. So if I made a personal contribution into the fund, I'd then get 20% extra added on in the fund, and potentially, subject to it still being around higher rate relief if I'm a higher rate taxpayer. So it's really stripping away a lot of the benefits of salary sacrifice. And the employer then will pay employer national insurance contributions of 15% on that pension, which might make them change that. It'll certainly, I would think, stop employers for giving that additional percentage on to their employees, so therefore the employee saves less, and it would also potentially mean that they are less flexible about allowing excess contributions because it's going to cost them more. Yeah, I think. Yeah, I mean, we'll have to see the way the rules work, but undoubtedly, yeah, that situation where the employer shares some or all of that national insurance saving with the employee by making extra employer contributions, that is going to disappear because they are effectively, the employer is going to be faced over that 2K limit with paying employers national insurance. So I'm, as an employer, not making a saving anymore. So I'm sorry, Mr. Employee or Mrs. Employee, I'm not going to actually be able to share that benefit. So it means that overall there's going to be less going into people's pension funds. It'll be interesting to see the detail on how that pans out. Exactly. Again, for those smaller owner-managed businesses, where quite often we're saying that almost the only tax planning advantage left whenever you run a limited company is to make employer pension contributions to reduce corporation tax and separate
sort of business, personal and business wealth, it's going to become a little bit more, well, less cost effective and tricky to plan.
Yeah, exactly. It's just what it's doing is it's just adding layers and layers of complexity on all the time and making those calculations, whether it's for yourself as a business owner or whether it's for one of the employees of your business. It's effectively making that calculation about how do I maximize the return to me and my employees, in a post-tax way. So
let's move on from that, because I'm conscious we want to rattle through as much as we can.
Yes, of course, yeah, absolutely.
Quite quickly. We were surprised perhaps that there wasn't any major change announced to CGT, and no further reduction to BADR, business asset disposal relief. Yeah. But then again, that was hit quite hard last year.
Correct, yeah.
But was it a surprise to hear the EOT rates being changed?
I think it was a real surprise to hear the EOT rate. Yeah, I think that was the biggest surprise, and something that I find a little unfortunate, really. So I spent along with Catherine, spent yesterday at the Employee Ownership Association conference in Telford, and there was a real positive feeling around there, this growth in employee ownership, which is, to a large extent encouraged by the fact that at the moment, as of yesterday, if you sold your business to an employee ownership trust, you'd get 100% tax relief on the capital gain. So it really was quite a big surprise and quite deflating, if I'm brutally honest, to see that the government's now moved to say, well, actually you only get 50% relief on that. Again, don't quite know how the mechanics are going to work, but I would imagine if you make a capital gain of £1 million in total, half of that, 500,000, will now be tax-free, and half of it will be subject to capital gains tax.
Yeah, I would presume that business asset disposal relief will still be available on the first £1 million again?
I think that has to be the assumption. Again, we'll need to see the detail, but I think it has to be the assumption that there will still be some concession in terms of the rate of tax. But as you say, it's only on the first £1 million per person, and effective from April next year, it's only going to be the difference between 24% and 18% capital gains tax rate. So, and I think in one sense, I can understand the logic to a certain extent of changing it from today's date, because you don't want a lot of people rushing around before April trying to sell their businesses to employee ownership trusts in order to get the 0% tax rate. But it really does massively impact on people who are going through that transition at the moment, who may not, for whatever reason, have been able to get the sale over the line pre-budget. They're now going to be in an entirely different world order than they would have expected yesterday.
And while we always say that if tax is the reason why you're doing an EOT, you're doing it for the wrong reason, it is still something that you factor into the whole planning. So if you've started down that road, you've got one thing factored in. And sometimes the owners also sell the business to the trust for less than they could otherwise get on the open market, because they know they won't have to pay that tax.
I think that's exactly the point. I think the fact is that you would get more if you went to a trade buyer for your business. You would probably get more for that. You pay capital gains tax. So then the concession was really to kind of bridge that gap to a certain extent. Mm-hmm. So as you could sell it for less but still end up with the same post-tax cash potentially. It's obviously depends on how the numbers work. It might push more people to say, well, actually, it was kind of borderline as to whether employee ownership was the right way to go. Actually, now, because I'm not getting that tax benefit, even if that's not the main motivator, I've got to think about myself and look after myself into the future. And, that could be enough to tip people towards actually selling to a trade buyer rather than to an EOT.
Again, interesting to see that plan side. Other things that were leaked before the budget, there was a lot of talk about EMI schemes and different changes to incentivising key people, and also investment relief for sort of EIS and VCT. I don't want to go into the detail of all of those schemes, but what was said in the budget, was there any detail given in the budget about what these changes might?
I think so for EMI schemes, enterprise management incentive schemes, which is what we call a tax advantaged option scheme, they are quite limited in that you can only have, for example, 250 employees, and there's only a certain amount of value that can be under option. And that has historically prevented some larger businesses from actually issuing these EMI options, We don't know the detail, but it sounds like they're actually going to increase those limits, which kind of widens the ability to participate.
So from startup to scale up.
Yeah, exactly. Pick a cliche, any cliche really. But so that, that's potentially a positive thing. Although I think there's still no change to the rules that say that certain types of businesses, like for example accountancy firms, we can't do it from a enterprise investment scheme and a venture capital trust scheme. So these are tax advantaged investments where essentially, the idea is you're investing in higher risk businesses, so the tax system gives you a bit of a cushion. So if the investment falls over, you've had some tax compensation for those investments. Historically, they've been targeted again at smaller early stage businesses, and again, it sounds like they're potentially going to extend those to actually encourage or to allow investors to get the same relief, perhaps investing in businesses that have grown more than than might be the case. All of these, though, I think this is the mindset shift for SME owners to take advantage of these, is that you are giving up part of the equity in your business. So, but actually, I think there's the opportunity, and this hopefully will encourage more people to take advantage of these schemes, because I think that extra bit of incentivization for employees or growth capital from investors can be the difference between a business which kind of does well and a business that really flies.
Yeah. Okay. Well, let's move to then when a business maybe has flown, and we're talking about IHT planning, and again sort of long-term planning, pensions, etc. We were a little bit worried that the lifetime allowance or the 25% tax-free cash might be reduced, but that didn't happen. Were there any changes to the rules? And we'd also maybe hoped the APR, agricultural property relief, and BPR, business property relief, might be made a little bit more generous than announced last year. Any changes there or to IHT?
Very, very few really. So I think the big relief is that there's no significant pension changes really in terms of the amount that you can contribute, the higher rate relief, and the sort of the ability to take tax-free cash out. So real positive there. As you say, unfortunately, most of the changes that were announced last year around agricultural property relief, business property relief, haven't been wound back. They're going to be introduced as was planned. I think the one positive change, and I think there'll be a huge sigh of relief, even if most people are still disappointed that the rules come in as they stand, is you had £1 million allowance per person, but unlike other IHT allowances, they couldn't transfer between spouses on first death. So what the Chancellor announced today is actually that £1 million allowance will be able to transfer, and actually that can make a really, really significant difference. Because effectively there was a risk under the system as it was previously announced that it was a use it or lose it. If you didn't use it on first death, you lost it. Here now, at least we are seeing that transferred. So I think perhaps a lot of the worry that people had about, do I need to change my will? Do I need to look at passing this on directly to the kids rather than passing it on to my surviving spouse? A lot of that might have gone away. I think there's still work to be done for people to sort of manage their exposure under the new rules. But at least that's one thing which is a real, a positive change. It's just a shame it's taken 13 months for them to reach the same conclusion that everybody else reached on the day after the budget last year, that this is the logical thing.
But again, will only apply to married or civil relationships.
Right? Yeah, exactly.
Okay. So, I suppose succession planning, gifting, all of those things for business owners becomes more and more important to plan early.
It absolutely does. I think that none of that has gone away. There was a hope that £1 million might get increased to say 5 million for the sake of argument, which would take vast swathes of farm businesses and small and medium enterprises out. But unfortunately, they've decided to not change those rules. So the conversations we've been having with clients about that early planning and looking at gifting, use of trusts, still remain entirely valid.
Yeah. Okay. There was some conversation about trust. There's also some conversation about the fact that none of the nil rate bands have been extended. Yeah. So again, that's another of these thresholds or fiscal drag.
It's yet more fiscal drag. Yeah, they keep pushing back. So the 325,000 nil rate band has been that level since Adam was allowed, unfortunately. So,
what about this mansion tax? What's that all about?
Yeah, so this is effectively, again, possibly could have been worse kind of moment with this one, in the sense that there was some speculation that they might increase council tax for council tax bands above, I can never remember, is it our council band F or whatever? But what they've actually introduced is this mansion tax, which is really aimed at properties that are valued over £2 million.
Because actually a council tax band F in one part of the country might be on a property much lower value.
Yeah, and I think in fairness, the Chancellor did use that example in her speech. So I think, you know, there is a sense in what they've done, which is essentially to say, well, if your house is worth more than £2 million, then there'll be a £2,500 a year charge, going up to a £7,500 a year charge if your house is worth £5 million. Now, you know, as with all of these other things, the policing of it's going to be an interesting challenge, and valuation even of properties is such a subjective thing that I can see that there's going to be a lot of room for, you know, houses potentially getting sold for £1,999,000, something like that.
I wonder what it'll do to the property market as well.
Yeah, again, it might artificially sort of start to impact on the property market. Having said that, and I think it's a fair point, you know, if you've got a house that's worth £5 million, then £7,500 probably not, you know, as significant an impact as somebody who's kind of in council tax band C, for example. So
yeah, well, sticking with property then, because there has actually been a little bit of good news for the retail hospitality sectors in terms of property business rates.
Yeah, so I think there was an announcement, which, as you say, I think is really, really positive, but, you know, aimed at SMEs, but particularly I think retail and hospitality businesses who probably have, you know, had the toughest time of anybody as a sector over the last few years. Massively, and the NI increased that sort of impacted massively on them as well last year.
Energy costs, they've just had a
succession of hits. They really have. So we don't again know a great deal of the detail, but essentially it seems like there's going to be reductions in the property taxes that those businesses are paying, and it looks like either directly or indirectly they're going to be funded by, you know, potentially increase in rates for some of the larger businesses, which, you know, to me seems a perfectly reasonable way to redistribute and actually provide some benefit to some of these these businesses where people are working damned hard to really make very little money. So hopefully we'll see some positive impact from that.
And they said they're going to try and equalise the cost of sort of stop online retailers being able to undercut bricks and mortar retailers by adding a customs duty to every single parcel, no matter what size.
Yeah, again, a compliance nightmare, I would say. But
I wonder how that will impact on people that sell their old belongings and things on Vinted and the small retailers on Etsy and places like that.
I suspect it's probably only going to apply to people who are sort of shipping these goods from overseas. So I would imagine with it being a customs duty that it'll only be if it comes cross-border from overseas. I don't know. I mean, I am speculating to a certain extent, but that seems the sort of logical conclusion. So it's not going to necessarily help competition between the big Amazon warehouse on the M62 and the corner shop, but you know, where people are ordering from overseas, potentially we might at least see a little bit of equalisation.
So speaking of nightmares in terms of how it gets measured and policed, we're going to have an EV road duty come in per mile, which is going to be measured every single year. Now, again, as tax advisors, we've long been talking to business owners of the unlimited company. Actually having an electric vehicle through your limited company is quite a tax effective way to motor.
Absolutely, and I think this one does win the prize for the most likely to cost more to enforce than it actually raises kind of situation, really. I've got no idea how they're planning to raise it, but essentially there is going to be a 3p a mile levy on electric vehicles, and I think was it 1.5p on plug-in hybrids. And I guess the logic.
But you're going to have to annually put give your mileage.
And I mean, look, you know, I'm speculating, but I'm sure probably we all know that you know, if you're approaching a particular service level, the manufacturer seems to magically know that that's approaching. So they are probably gathering this data at the moment. But and
that's a good point. I hope they can do it properly, because even in my oldest working days, I was rubbish at clearing my mileage allowance from my employer.
I think
was just trying to keep those
it's just not something you think about unless you've got a leased vehicle and it's getting to the end and you realise you've only got 2 miles left to drive in 3 months.
And they said that they can collect it and it can be double checked at MOT time, but most EVs are taken on a lease or purchased a brand new vehicle, so they don't require an MOT. Yeah,
I know. I mean, look, who knows? I mean, it sounds like, and again, you know, they're not paying fuel duty because they're not, you know, going to the petrol pump or the diesel pump, but But the idea sounds quite whizzy, but the implementation sounds like a potential for disaster.
Unless, as you say, it can be done.
You'd have to assume there may well be some way that
AI can do that one for us.
You'd like to think so.
I think that there are other sort of what they call sin taxes: vaping, alcohol, gambling, online betting. And I think there's probably tobacco as well. I think those are probably good potential taxes to have to try and save people from themselves a little bit. But interesting, online betting's been tightened, but horse racing escapes. Any thoughts on that?
In a word, no. I've got no idea what the logic for that is. I think the research is that online betting is the one that leads to the most problem behaviour, as opposed to betting on course or walking into the bookies down the road. But and look, I think sort of from the man in the street's point of view, it's hard to argue that actually, as you say, trying to prevent people from betting themselves into a world of pain. But
the Chancellor also used a lot of words to talk about something that they were doing to support pubs, but I couldn't actually figure out what that was.
No, there was some of the messaging was at best a little unclear, and I think it's a bit frustrating that we haven't had a lot of the detail. We normally get it fairly much straight after, but it seems
to be quite vague, actually.
It will come out over time, of course it will, but typically you get a fairly decent summary pretty much straight after the budget, but we have been scrabbling around to try and work things out a little bit.
Okay, well, I'm going to give you just a couple of last practical sort of questions or next steps. And if there's anybody that is watching that wants to ask any questions, please feel free to do so, and we'll try our best to answer those. So for the SME and owner-managed business clients that are watching today, what are the 3 most important actions that they should take before Christmas? Before Christmas?
Well, I think the first thing is really to start, rather than leaving it till the 5th of April to worry about how you're going to pay yourself next year. I think start having those conversations early to understand what is the impact of that dividend tax on my mix between remuneration and salary. I think that's really, really important. I think, again, understanding the impact of that national minimum wage, that national living wage increase on your business is really, really key. Just everybody should be doing budgets and forecasting and really understanding what the financials are going to look like next year, and if you don't do that, it's going to come as a nasty surprise when those wage increases come through. And then I think it is, look, every SME owner is going to have an exit of some description at some point in the future, whether it's the old wooden box exit or whether it's kind of they sell or they go for an employee ownership trust or whatever. But I think it's a good opportunity to take a step back and say, okay, what is the long-term plan here? The tax system is not going to improve in terms of how it treats entrepreneurs in coming years. I think that's very clear. So if you've got time over your Christmas pud or something like that, just to reflect a little bit on the future and think about, well, why am I doing this? What do these changes actually mean to me? Not just in the short term, but also in the long term as well. I think that will be time well spent.
I must say, personally, I always find that period over Christmas the best time to actually have some downtime and take the pressure off, because it's the only holiday where everybody else is on holiday.
Exactly.
So you're not constantly answering emails and being in the reactive day-to-day operational part of the business.
I totally agree. I think it's kind of just reflect and look back at the year that's happened and look at not just this coming year, but also the way the tax system heading and how that impacts on your thinking. Because the reality is, for all the chancellor's fine words about reducing the deficit and getting into a public sector spending surplus, the reality is that tax rates aren't coming down anytime soon, and people are having to effectively work harder and harder all the time just to maintain themselves at the same level of income as they've had previously post-tax.
And for those people who are thinking more about the inheritance tax or that sort of planning, what advice would you give them right now?
Well, I think nothing has really changed in the budget, save, as I say, for this welcome concession around the £1 million allowance. So it really is taking a step back again and thinking, well, the old sort of, particularly for if you own a trade in business, debt's the best form of tax planning. That isn't the case anymore, and it's really about understanding what the IHT changes, which, let's face it, we're now 26th of November and they kick in from 6th of April. So, this time last year we were thinking at least we've got quite a long time to plan for this. Well, suddenly we don't have a very long time to plan for this at all. And I think, it makes...
And bearing in mind that the accountants and tax advisors will be very busy in the period to the end of January, so it really only gives February and March to do that planning.
Yeah, and I think look, it's fair to say that there may only be a limited number of actions that you might want to take before 6th of April, but with IHT, it's all about the 7-year clock and starting that ticking. And I think, the sooner you can put yourself in a position where you've at least thought and come to a reasonable view, and that view might be, I'm not going to change anything, but at least if you've kind of challenged yourself, asked yourself the question, and you've got to that conclusion, that's fine. IHT is often said to be a tax that's paid by the unprepared, and I think there is a certain element of truth in that, because with planning you can reduce IHT, you can't necessarily eliminate it altogether.
No, and we all are happy to pay our share of taxes because we want the services that those taxes provide. So it's not about avoiding tax; it's about just planning and preparing for the best. Don't
pay any more than you need to.
Yeah.
But equally, don't try and reduce it to the extent that it's going to compromise, your income, your future ability to enjoy your retirement. Because, as you say, it's a bit of a cliche, but I do think that there is actually a civic duty to actually fund services. If we want to use them, then we need to be prepared to pay for them.
Is there one final piece of advice that you would give to business owners out there who are trying to navigate these changes at the moment?
I think it is just have the conversation with your advisors, because the system is becoming more and more complicated all the time. I mean, the reality is that a lot of people who are doing this for a living day in, day out will take some time to process these changes and understand what they actually mean. So, for the business owner who's busy trying to keep their business ticking over and make money, use the skills and the knowledge of your advisors to help you to get to the optimum position, because if you try and work it out for yourself, the chances are you might end up making some bad decisions.
Yeah, that's good advice. I mean, I think the only other thing from my point of view would be that these changes are fact. So there's nothing that complaining or moaning about them can do.
Exactly.
So actually,
right,
we've got to take responsibility for our businesses, for our profitability, for looking after our employees and making the most of it. So sometimes, back when I started out working for myself in 2007, just before the credit crunch, a long time ago, what I saw was that it wasn't necessarily a certain type of business that failed, it was a certain type of mindset in the business owner. And I think we've got to go into this and into business in general with the mindset of, right, what can I do and how can I make this work? And as long as we're thinking in that way, you can find solutions. You just might need to make some tough decisions, but you'll be able to find solutions to come through all of these changes profitably and healthily. Yeah.
I couldn't agree more. Survive, adapt, thrive was the mantra through COVID, and I think it's the same now in the challenging environment that we've got. First of all, get through it. Secondly, make the changes you need to, and then you'll come out of the other end a better business from it. So.
And the beauty that small business owners have is we are flexible, we are adaptable. We don't have a huge amount of red tape to jump through, so we can make fast decisions and actually take ownership of our future.
Couldn't agree more.
So brilliant. Thank you so much for your insights.
Absolute pleasure.
Thank you. Bye for now.